Good afternoon and happy Thursday, everyone. It is Scott Wolders with River Place Capital. It is Thursday, March the 13th, and I want to take just a brief minute to discuss what markets did last week, as it was a down week as markets pulled back, and we'll explain why they pulled back here in just a minute. But the S&P 500 on the week was down 3.1%. The mid-cap index, as measured by the S&P 400, was down 3.49%, so a little worse. And again, the small caps, it was a get me out week. They were down 3.4%, a little worse than the S&P 500. And what really sent the market tumbling towards the end of last week was the Atlanta Fed came out with their guidance on first quarter GDP growth for their region, which is the Atlanta region, the Southeast region. And they had predicted a 4% growth rate for the economy for the first quarter of the year, and they revised that down to a negative 2.8% growth rate for the quarter for the United States. So that sent the markets tumbling. And why that is it's because of the uncertainty around the tariff policy that is, and the economic policy that is being administered by the current administration, and the market is trying to digest that. And what is causing all of this turmoil or in the market or volatility in the market is the uncertainty around, are there going to be, when are they going to be, when are they actually going to take effect, are they going to take effect, on what goods, and for how long. That has changed very rapidly in the last couple of weeks, and what we're seeing and what the Atlanta Fed is seeing is what most small business owners would do in an environment, what most business owners would do, or what most consumers would do in an environment of uncertainty. Is it's not that you know are going down into a huge crash or anything, but you stop for a second and you go, well, I want to wait and see some clarity here. So I'm going to pause my spending initiatives. I'm going to pause my new campaign that I was going to launch this year. I'm going to pause some of these things to let the economics play out of these policies so I understand how they're going to impact me more and I can move forward. That's what you're seeing, and that's why the fears of recession have taken over in the marketplace, and that's what has led to selling down the end of last week into this week. Now this week we got CPI report that came in better than expectations. Year over year yesterday we got headline CPI at 2.8%. Today we got producer price index or PPI flat month over month, not changing. Normally good signs for the market. You saw a market kind of try to get some legs and rally yesterday off of the news of the inflation data, the CPI report. But you move forward to today, you get PPI flat. You should have a nice rebound day, but retaliatory tariffs on Europe on goods and Europe announcing tariffs on our goods has sent the market south for the day, again letting the recession fears and the growth slowing fears take hold in the market. So what do you do as an investor when this is the case? Well, there's a couple things I want to talk about. Year to date, the S&P is down 6%. Standard 5% pullback that we get at least once a year, we've hit that. We really think as River Place that we may be very close to a bottom here. Now there could always be something that changes that and we can move lower, but what we're seeing is a market that's trying to create a bottom and some lift upward. You're not seeing that today on Thursday at 135 in the market, but the market is, if you look internally, really trying to take a turn and move there. But if you're looking at how to navigate on a short-term perspective, the NASDAQ's down over 10% year to date. It's had a 10% pullback. So if you're looking for things that are on sale, that may be the place to go. But however, you need to have a long-term time horizon if you're looking into some of these growthier names. Expect some continued volatility throughout the year as investors are really looking for their more stable, mature companies that return capital to shareholders in the forms of dividends and share buybacks. What we've been talking about for a while, which are going to be your more value-oriented names, the ones that aren't going to be as sensitive to macroeconomic shocks. Now, what will eventually happen is if we do get that growth slow down, investors will then switch from the old mature companies that aren't impacted as much initially And then they'll move to the growthier companies as they see that we are in a slowdown for the ways that we can get out of that slowdown. So we aren't getting confirmation of the slowdown yet, so you're still seeing money flow into the value sector of the economy. So if you're looking for a place to hide, not necessarily a bad place in the time being, but again, like we said, it's never a bad time to pick up something on sale. So as you're looking through your list, if you have a long-term time horizon, it's not a bad idea to start looking at some of your names on your watch list. If you have excess capital or some that you don't think are going to recover as quickly as others, wouldn't be a bad time to look at that. So as always, if you have questions about how to navigate these markets, what's causing the volatility, when is it a good time to buy, when is it not, how do I position my portfolio, feel free to give us a call. We'd love the opportunity to speak to you. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. Have a wonderful rest of your week. Everyone, thanks so much for watching.